Ladies and gentlemen, it's time to review how to protect your assets from a fraudulent annuity sale transaction. I'm Stephen Pluga with WatchGuard Capital, and today we're covering an annuity recommendation made by Gerald M. Kennedy of J. Kennedy Financial Group, who was acting as an independent agent for American International Group, which you may know better as AIG. The annuity he recommended to a pair of hardworking Americans turned out to have an embedded 10% initial surrender charge that would have taken a decade to fully disappear. And if this sounds like financial jargon that you don't quite understand, please sit back, relax, watch and share this video, as it could be the difference between millions of dollars in retirement for you, a loved one, or a friend.
A quick search for your state's Department of Insurance is a great starting point. Typically, your state will have a search tool for you to use in the consumer section of the website. Plug in the name of your insurance agent in the search tool and see if you get any hits. Kennedy, Jerry. And there he is. Select View Agent Profile to see license information, and we can just click View All. And voila. There's AIG, active license, no problem there. Take a quick look at the terminated appointments. Canceled, yep, standard stuff. But I may want to know what these canceled for cause terminations were for, but so far everything looks normal. Now the next tool to check is brokercheck.org. Jerry Kennedy. And there's the one I'm looking for, address matches. Looks like he was a broker, is still an investment advisor, and has one disclosure to review. Here is some work history, and that disclosure, let's check on that. Initiated by NASDA, or the National Association of Security Dealers. Allegations, NASDA Rule 2110, responded to fix the signatures of public customers without their knowledge or approval on switch letters which explain the actual or potential charges associated with selling mutual funds from one fund family and purchasing mutual funds in another family. Regulatory statement. Without admitting or denying the allegations, Kennedy consented to the described sanctions and to the entry of findings. Therefore, he is suspended from association with any NASDA member in any capacity for 3 months, with credit for 45 of the 90 days that he was suspended by the firm, and fined $5,000, with credit for $2,300 in commissions that his firm disallowed Kennedy because of his violative conduct. The suspension shall begin on January 3, 2005, and will conclude on February 16, 2005. Fines paid. So the allegations were that he forged client signatures to swap them from one mutual fund to another to generate commissions. Ladies and gentlemen, this is, and was, the first official red flag during my review. Now I spoke with Mr. Kennedy on Tuesday, February 16, 2016, and requested standard information to complete a due diligence review on the annuity he was recommending. The next day, Mr. Kennedy sent me the requested information via email. Here you go, Stephen. These are great vehicles, but just like everything, have to be monitored and reallocated annually. They're designed like the movie Moneyball. They're designed to get on base. Laugh out loud. Any questions, give me a call, Jerry. Who kindly provided me 2 links, one on fixed index annuities and one just for fun in case that's what we're having. Email number 2 that was sent 5 minutes later was the official red flag number 2 because the information I requested was sent in a dot pages format, which is Apple's equivalent to Word doc. Official sales literature should never come in a Word or Pages format. Let's review that AIG.Pages attachment. Starts out normal, an American General Life Annuity informational piece. Looks like we're going over credit ratings, and whoa, we switched from AIG to Merrill Lynch, and we switched fonts. That was odd. Another font switch, but still Merrill Lynch. But that is a lot of different fonts, and that is also a lot of white space. Where are all the disclaimers, and why is this page blank? Okay, so this is obviously a poorly cobbled together piece of sales literature from other marketing materials. How do I know that it was cobbled together? Because I Googled it. In fact, if you copy and pasted this text into a Google search bar, you would find this. Look familiar? It should. It was the first part of the document we just reviewed. Well, besides these 2 paragraphs on associated risk, and also this one down here, those 3 paragraphs were omitted. Remember this paragraph here? The first font change to Merrill Lynch. Select all, copy and paste into a Google search bar, and you'll find this document. Looks like more information on risk, some disclaimers, and there it is. Last but not least, the ML Strategic Balance Index. Copy and paste, Google search, and you'll find this document. Definitely looks familiar, except this page that goes over associated risk and embedded cost, all the information that are requested on Tuesday, February 16th. But I was provided this, a blank page. This was the last email I received, which simply stated, page 5 is the backtesting and had 1 PDF attachment. The first thing I noticed when I opened the PDF is that the document was generically prepared for a valued client and not a specific client. I would think one would update the name when recommending a strategy for a majority of someone's life savings. Page 2 was concerning because it disclosed that the annuity had a 10% initial surrender charge to get out of this contract that declined over 10 years, which was never mentioned during the discussion I had with Mr. Kennedy or reflected in the AIG.pages document he sent me. Also, remember that email that just said backtesting is on page 5? This report states that it includes up to 5 scenarios or hypothetical illustrations of the Power Select Builder Index annuity. Page 5 only showed one hypothetical scenario, the MLSB repeated period, and it's not even truly a backtesting scenario, which we'll cover more next. I did find it convenient that Mr. Kennedy did not direct me to page 8, which showed 2 of the other hypothetical scenarios that were in fact backtesting scenarios and showed the wide range of possible outcomes. The hypothetical accounts value favorable period, which was from 1994 to 2004, had an average credited interest rate of 8.53% per year, which generated $547,387 in interest earned over 10 years. There were $180,000 in withdrawals and an ending value of $907,387. The hypothetical accounts value unfavorable period, which was from 1998 to 2008, had an average credited interest rate of 3.32% per year, or 5.21% less on average than the favorable scenario, generated $166,461 in interest earned over 10 years, or roughly $381,000 less. Withdrawals were the same at $180,000, but the lower average interest rate resulted in an ending value of $526,460, or about 42% less than the favorable period. That is a wide range and is backtesting. But let's do review page 5 now. And let's do this section first. The following items threw me off. The client was not 55, would not take the first withdrawal at 57. The client did not live in Minnesota, and Mr. Kennedy is not registered to sell insurance in Minnesota. The account was actually qualified, which means sheltered for tax reasons, and in this case retirement, and the initial premium was not $500,000. But let's ignore these red flags and review the hypothetical rate of return and where it comes from. The first clue is MLSB repeated period. Refer to page 3. So let's go there.
All right, so the MLSB stands for the ML Strategic Balance Index, and the ML stands for Merrill Lynch. Basically, the index combines stocks and bonds to target a 6% volatility by using the S&P 500 and the Merrill Lynch 10-year Treasury Bond Index in cash.
First, go to watchguardcapital.com, click on Resources, and download this complimentary investment primer which I wrote to give investors an overview of Harry Markowitz's modern portfolio theory, which will walk you through how an investor should decide on a conservative, moderate, or aggressive portfolio strategy, introduce you to the annual returns of bonds and stocks over 30 years, the impact of compounding those returns over time, and rebalancing and risk management, how to determine your reasonable rate of return with an associated risk, and even your emotional response to negative returns. In my opinion, a portfolio that attempts to reduce volatility or fluctuations both up and down within 6% is inefficient because it has too high of an opportunity cost. And I would expect a 100% broad-based U.S. bond portfolio to have roughly a 6% expected volatility or standard deviation. And since adding a little variance doesn't substantially increase the expected worst annual return until the investor passes through the 20 to 25% aggressive investment exposure level, I would have to question the underlying motives of any strategy that is deploying leverage, yet targeting a 6% volatility level, especially since volatility is only half of the equation. The other half of that equation is return. Bumping the targeted volatility up from 6.7 to 7.2% as indicated by the orange dotted line increases the expected average return from 7.7 to 9.0% in this scenario as indicated by the gray bars. In other words, you get 2.7 units of expected return for each unit of accepted variation in this corridor, while the expected worst year remains marginally the same. Now that you have a basic introduction to portfolio construction and metrics you would need to analyze a strategy, you would need to find information specific to Merrill Lynch's ML Strategic Balanced Index. Okay, so for the last 5 years, or since June 2014, the index went from 224 to 1497, or 273 points of change, a 22.3% positive change, or roughly 4.4% on average per year. Is 4.4% annually on average a good return? I don't know, but it is below the page 5 6.82% illustrated average return, and when I deduct AIG's 2.2% spread, which is an expense to the annuity purchaser, the 4.4% average since 2014 reduces somewhere down to about 2%. Keep in mind that there are 7 different investment strategies with different participation rates, caps, spreads, and interest rate methodologies that could be allocated to, and all these details can change annually, so there are a lot of scenarios that could be analyzed. But it appears the calculations are based off a 100% allocation to the 2-year point-to-point MLSB strategy, even though the contract application that was pre-filled by Mr. Kennedy only allocated 25% to the 2-year point-to-point strategy and 75% to the annual point-to-point strategy. But let's go with the 100% allocation to 2-year point-to-point MLSB since that's what I was told to review. Another Google search, MLSB fact sheet. Okay, 6% volatility, an index fee of 0.5%, and that is a conflict of interest because the higher that fee, the less AIG has to pay you. Most indexes don't purposely embed an index fee, so that is a creative way of charging an indirect expense. Interesting that the base date of this index is 1985 and that it went live in 2014. But on page 5 of the illustration by AIG, it chose to perform calculations using the last 4 years of the index beginning in 2010 and then repeats the last 10 years beginning in 2004 twice, which looks something like this, where the returns from 2005 to 2014 are used and then reused for the period between 95 to 2004, and then the returns from 2011 to 2014 are reused to represent the period between 91 and 94, even though the index goes back to 1985. I would always have to question why that decision was made. The last paragraph is interesting to me because I don't typically associate leveraging a portfolio with a volatility reduction strategy, which is this annuity's #1 priority.
Okay, so now to recap. The index can allocate funds to the U.S. large stock market, the 10-year Treasury market, or cash, and its main objective is to keep volatility at 6%. Now imagine that you're expecting a return around 6%, but you get 14 instead. That's good variance. But instead imagine that you get -2%, that's bad variance. But technically they're both 8% swings. The index doesn't necessarily treat these two types of swings differently, and at this point you're thinking that's odd. Welcome to the party. Let's talk about the index's use of leveraging, which allows the index to borrow against itself and actually have more than 100% exposure to the stock and bond markets. If a portion of the index was allocated to cash and not exposed to market fluctuations, it accrues interest, which is interest indirectly being paid to you. If the index is leveraged past 100% exposure to these markets, the leveraged portion of the index has to pay interest and is deducted from performance, which is an indirect expense to you. In either case, the interest rate used to determine this calculation is the 3-month London Interbank Offered Rate, or LIBOR. Right now, the MLSB index is exposed 34% to the S&P 500 stock market index, 116% to the 10-year Merrill Lynch Treasury bond asset for a total exposure of 150%, 50% of which is leverage, and is being charged interest based off the 3-month LIBOR by reducing performance. If the index didn't want to be leveraged, it would have to reduce some combination of exposure to the S&P 500 or 10-year Treasury market down to a combination of 100% or less. The indirect cost to performance of paying 3-month LIBOR was about 1/4 point in 2014, but is now about 2.4% annually. The increase in this indirect expense helps somewhat explain why, despite being provided a 24-year illustration of hypothetical returns and an unfavorable period backtesting dating as far back as 98, where the worst years were -0.44% in 98 and -0.36% in 2008, the index has produced returns of -1.41% in 2015 and -2.93% in 2018. Okay, one last calculation because I love PortfolioVisualizer.com. What would happen if I invested $500,000 back in 1991 for 24 years until 2014, and I took periodic withdrawals of $20,000 a year, not adjusted for inflation to keep them constant and compare apples to apples with the provided illustration? Rebalanced once a year annually, and I put some money in the S&P 500 stock market and some in the 10-year Treasury market with no leverage. And let's just put the current MLSB stock exposure rate of 34%, and the rest goes into bonds, and I analyze that portfolio. I'd have had a standard deviation or volatility expectation of about 6.5%, but my final balance would be about $2.3 million, substantially north of the $755,000 expectation found on the page 5 illustration. And that, my friends, is the true opportunity cost of this AIG annuity. And before anybody gets on my case that theoretical indexes don't have embedded operating expense ratios or OERs, I grabbed the top 2 exchange-traded funds according to ETFdatabase.com that track the S&P 500 and the 10-year Treasury market, SPY and IEF, and I ran them through the same scenario. 1991 to 2014, initial investment of $500,000, $20,000 per year withdrawal, not adjusted for inflation, rebalanced annually, and analyzed. Looks like IEF was created August 2002, so 2003 was the first full calendar year. But despite investing for 12 years less, or half as long, the ending balance was $811,000, or $60,000 more than the expected ending balance from the page 5 illustration. If I go back to the previous index calculations, change the start year to 2003, analyze once more, the ending expected balance is still more than the 24-year page 5 illustration, despite only investing half as long. And that is why I did not appreciate getting a blank page from Mr. Kennedy.
Nor did I appreciate the fact that even though I spoke with Mr. Kennedy again on Wednesday, February 17, 2016, and he told me he wouldn't submit the checks for the AIG annuities, he had already actually done so that very morning, and I only found out because I called AIG directly that Friday.
Which brings me to my next point, the importance of independent analysis if you're unable to do it yourself. I started my due diligence review on a Tuesday and had paperwork to AIG by Friday to cancel the contracts that were sold under false pretenses. Unfortunately, what I did not know at the time is that this whole process started a month earlier when Mr. Kennedy coordinated a call with Jackson National Life Insurance Company and the couple so that he could scoff at Jackson's fees and recommend they swap from Jackson, LPL, and the original financial advisor and come under his care. He conveniently did not mention to the couple that Jackson would charge a surrender fee if they took his advice, much like he did not mention the surrender fee on AIG's annuity to me. However, the surrender fee on the Jackson annuity would have dropped if the transfer would have just occurred 16 days later. And at this point, you're probably thinking they should have laws against this kind of stuff. They actually do, and lots of them, which is why Mr. Kennedy advised them to do an indirect rollover and not a direct rollover. You see, if the funds went directly from Jackson to AIG, he would have had to disclose it to AIG's compliance department to make sure it was in the client's best interest to exchange the contracts, including the decision not to wait 16 days for the surrender fees to drop from 5% to 4% on subsequent premiums. But if he encouraged them to cash out the annuity, take the retirement in their bank account, then deposit the funds back into a qualified retirement account and sell them a fresh annuity, Mr. Kennedy could avoid filling out all those forms that are specifically designed to stop this type of transaction. You do have to give AIG credit. They tried to block Mr. Kennedy's tactics. Here are some of the questions AIG asked on its annuity application forms during the sales process. All screenshots you're about to see are actual image of the original application that was pre-filled by Mr. Kennedy for the convenience of the clients.
Do you have any existing life insurance or annuity contracts? Pre-filled answer, no. Will the purchase of this annuity result in the replacement, termination, or change in value of an existing life insurance or annuity contracts? Pre-filled answer, no. Agent, broker, or advisor information and signatures. Do you have any reason to believe that the applicant has any existing life insurance or annuity contracts? Mr. Kennedy's answer, no. Which is an odd answer since you would have just had a three-way conversation with the clients in Jackson National Life Insurance Company about their annuity that is still in effect while you're signing this AIG application. Do you have any reason to believe that an existing life insurance or annuity contract has been or will be replaced, surrendered, withdrawn from, loaned against, changed, or otherwise reduced in value in connection with this transaction, assuming that the contract applied for will be issued? Mr. Kennedy's answer, no. Again, very odd. What is the source of funds for the purchase of this annuity? Check all that apply. Mr. Kennedy's pre-filled answers, annuity, no. Stocks, bonds, mutual funds, yes. And that's definitely not correct. What is the total contract value of the annuities you currently own? Amount excludes this annuity being purchased. Pre-filled answer, I do not own any other annuities. Will the purchase of this annuity result in a replacement of an existing annuity contract or life insurance policy? Pre-filled answer, no. Which financial, insurance, and investment products have you owned and or currently own? Check all that apply. CDs, stocks, bonds, mutual funds, yes. Annuities, no. I'm definitely seeing a pattern develop here with these pre-filled answers. This annuity being purchased is based on the recommendation of my agent. Pre-filled answer, yes. Well, that's definitely true. Are you considering discontinuing making premium payments, surrendering, forfeiting, assigning to the insurer, or otherwise terminating your existing policy or contract? Pre-filled answer, no. Well, that's definitely not true. Are you considering using funds from your existing policies or contracts to pay premiums due on the new policy or contracts? Pre-filled answer, no. If you answered yes to either of the above questions, list each existing policy or contract you are contemplating replacing, including the name of the insurer, the insured, the contract number if available, and whether each policy will be replaced or used as a source of financing. Well, I guess since Mr. Kennedy pre-filled the application with no and no, we can move right along. Complete Section 2, Replacements, if this transaction is a replacement. If this is not a replacement, please skip to Section 3. And it was a very good thing this section was skipped when considering the ability to close a sale, because had the surrender charges been indicated above, Mr. Kennedy would have had to explain why he felt it was more beneficial to replace now versus waiting for the surrender charge to expire. As a reminder, the current annuity with Jackson gets surrendered the day after this application is signed, 16 days shy of the surrender fee being reduced from 5% to 4% on subsequent premiums, and about 10 months before the fee drops in half on the rest of their life savings. So why did he think it was more beneficial to not wait? Could have been the heaped or trailing commissions he stood to make off this sale? I mean, the selling agent does earn a commission on the sale of this annuity, And his recommendation not to wait totally makes sense when you understand the incentive compensation. So that's probably why he felt comfortable certifying that the response provided herein are, and to the best of his knowledge, accurate. Signed, Gerald M. Kennedy.
And it's at this point you're thinking, wow, this is just not right. These people really do have a valid complaint. Open and shut case, right? I thought so, which is why I wrote this 11-page complaint letter detailing Mr. Kennedy's improper sales practices, including the fabricated sales literature, and I submitted it to the Ohio Department of Insurance. Then a few months later, I received the sales application from AIG, which you just viewed screenshots of. And I wrote this 5-page follow-on letter detailing how deceptive it was to pre-fill the application and facilitate an indirect rollover just to circumnavigate the procedures that prevent annuity switching to generate a sales commission. I sent that letter to the Ohio Department of Insurance and I waited. I'd follow up and they'd say, we can't comment on an open case. So I'd wait some more and then I'd call and they'd repeat the same message. And that went on for over 2 years until earlier this year when I called them, they said they would not comment on a case, which is different than an open case and caught me off guard. So I requested clarification. How would I know when the case was moving along or closed or anything at all? And they directed me to the website and suggested that I read the press releases on their website until the end of time, and I would know if they took any action against Mr. Kennedy, which is unacceptable, so I pressed harder. And it's at this time I learned that even if they found merit in the complaint that I gift wrapped for them, they couldn't actually enforce any type of restitution for the customers, and they suggested I consider other avenues to seek reimbursement, which blew my mind. And I could have used this information 2 years ago. After being shot down by multiple lawyers because their cut of the restitution would not be large enough to take on the case, I contacted Mr. Kennedy directly.
Mr. Kennedy, I believe you acted negligently in January of 2016 when you advised customers to transfer from a Jackson National Life Company annuity to an AIG annuity that resulted in surrender fees of a lot of money. The customers have authorized me to speak to you on their behalf. I'm giving you until 4:30 p.m. Eastern Time on Monday, March 4th, 2019 to convince me otherwise before I take additional action. Spoiler alert, Mr. Kennedy did not respond, so on Monday, March 4th, I sent the following email to Mr. Kennedy, Jackson, and AIG. Mr. Kennedy did not respond to the enclosed message, and the time is now 4:31 p.m. Eastern Time on Monday, March 4th, 2019. As such, additional actions are being taken. The attached letter captures negligent actions and advice by Gerald Michael Kennedy to customers that resulted in the surrender fees of a lot of money. Please respond by 4:30 p.m. Eastern Time on March 11, 2019 to convince me that my opinion is incorrect or that your involvement should be omitted from any additional actions I take. I promptly received this AIG correspondence which stated, "We take these matters very seriously and are in the process of conducting a thorough investigation into your concerns," which was great. I even received a second letter informing me that the investigation was so thorough it would require additional time, and 30 days later I received their findings. After careful review of your letter, we do not believe AIG is responsible for the reimbursement of surrender charges. Our decision is based on the following. First, both the agent and the customer signed the applications and client profiles indicating that no replacement of an annuity contract was involved in the purchase. Second, the premiums for American Group Life contracts were received by the way of personal checks, not by transfers from another company. Therefore, AIG was unaware that another annuity contract or any potential surrender charges were involved in the transaction.
So AIG, let me get this straight. You took 30 days to very seriously investigate my concerns, and then you responded to my 16 pages of detailed complaints with Mr. Kennedy, an independent agent appointed to sell on your behalf, who was suspended from any affiliation with a member of the National Association of Security Dealers for an allegation of affixing client signatures on mutual fund swap letters to generate improper commissions, who I clearly showed falsely pre-filled the AIG annuity applications both electronically and in his own handwriting, also stated that he provided accurate information to the customers regarding index annuities and provided a copy of this application, even though I specifically informed you on November 3rd, 2016 that he did not, in fact, leave copies as required by Ohio Administration Code, who also stated he had not made statements that differ from the disclosure form, sales material, or illustrations, yet in fact sent me a doctored sales literature piece in a dot pages format that I forwarded to AIG, who also stated he did not market this product as an alternative investment product, even though he did that exact thing to me, a seasoned financial professional, during our first phone call, and that the customers, acting on the recommendations of Mr. Kennedy and trusting in the AIG brand, signed this pre-filled application that was deliberately filled out to hide the fact that it was an indirect rollover, so that Mr. Kennedy could keep the AIG compliance department oblivious that this was a replacement transaction, which could have only benefited Mr. Kennedy by ensuring the sale was not blocked and the commission was collected, was enough for you to waive responsibility to reimburse the customer the surrender fees taken from their life savings that would have automatically reduced if they have just waited 16 days, because you were unaware of what was going on? Well, I'm actually not that surprised.
I understand and acknowledge that American General Life does not offer legal, financial, tax, investment, or estate planning advice, and I have had the opportunity to seek such advice from the proper sources before purchasing this annuity. This annuity is not risk-free or guaranteed safe and should not be described as such. It is only as sound as the issuing insurance company. Checks should be made payable to American General Life Insurance Company. AIG recommends you ask what expense and sales charges will you pay on the new policy on the application form. The clients asked Mr. Kennedy, and I asked AIG more formally in writing. Mr. Kennedy avoided the question. AIG's response? With regard to your request for commission information, commission agreements are between AGL and selling agencies and/or agents and are separate from the contract with the customer.
So if you're tired of stories like this one, here's your chance to help. I need you to subscribe and share this video, and I'll build the company that gives investors a voice. Contact me if you need me at info@watchguardcapital.com. I'm Stephen Pluga, signing out for now.